We mentioned last quarter ago, that we entered a bear market where we were down north of 20% in the stock market. That continued during the third quarter. What we can see here is that really all broad asset classes were negative for the quarter. We had US stock markets were down about 4.5%. International stocks were down as well, anywhere from 9 to 11%. Global real estate, this is publicly traded global real estate. These were down as a group, about 11%. And even the bond market. The bond market was down again about 4% in the US market and about 2% overseas. What we look at is we're comparing prices of stocks or of the index to the earnings that are generated. Okay. What we find right now, I'm going to zoom in on this. This is a valuation line. This gray line is looking at the price earnings valuation over time. And the fact that it's been coming down here is indicative of prices coming down. And we see here, this, by the way, is kind of the average, the 20-year average. And right now we're at a point where we are below average in terms of valuations, meaning stocks are cheaper than average based on historical standards. All right, so let's move over now to the bond market. Now, the bond market, this quite possibly has been the biggest surprise of the year. The bond market, this is looking at the aggregate index through the first 3 quarters, down about 14.6% total return. Right, that's been a very rare occurrence. We put together this analysis to say over the last 97 years, let's look at over the last 97 years, what has the bond market done on any given calendar year? Okay, as you can imagine, bonds, which tend to be less volatile than stocks, tend to be more stable, generate income over time, they tend to have fewer negative years. In fact, what we find here is that the green bars are positive calendar years. The red bars here, these are all the negative calendar years where the bond market had a negative result. Okay, and you can see here on this far right side, current time, this is this year as well as last year. This has occurred 12 times in history. We've seen roughly 12% of the time the bond market has been negative for a calendar year. That's very rare. If it seems unusual, it's because it is, right? The reasons we oftentimes as investors diversify across different types of investments, whether it's stocks, bonds, commodities, or real estate, is for that diversification benefit. You look to see assets move in different directions at different times to help smooth out the overall experience. Now, what we dug into to say, on this graph here, we have in blue bars are those same 12 negative years for the bond market going back to the 1920s. We then overlaid to say, what did the stock market do on those same years? To say, what did that diversifier, that typical historical diversifier, do in that time period? And what you may find interesting and maybe surprising too, what we find is that in 3 times in the last 97 years, we've had negative stocks and bonds occur at the same time. Because these diamonds are all on the top, whether it's municipals, investment grade corporates, mortgage-backed securities, again, back to treasuries, this tells us that the bond market today is offering higher yields than we've seen for really the last 10 years. Okay, and again, going back to the comment, starting yield is a strong predictor of what the bond outcome is going to be. All right, moving over to the economy, we're going to spend some time talking about inflation. Inflation ties into all this, of course, because this is the Federal Reserve has been increasing interest rates to help combat inflation. Headline inflation is starting to roll over in terms of rate of change compared to 1 year ago. This is expected because it's hard to continue to have growth on growth on growth, even in terms of the CPI basket. Now, on the flip side is that we have not seen this gray line here on this far side. We have not seen this roll over yet. This is the core inflation component that still has been rising. Right. So because of that, because inflation is still elevated, the Federal Reserve, as they stated last week, is going to continue on their path of increasing short-term interest rates. The jobs market, this is the other piece that keeps the Fed on their path of increasing rates, is that the jobs market remains quite robust still. It's still quite strong. In fact, the unemployment rate down here in the bottom left, right, that's at 3.5%. Okay, 3.5% unemployment is a very low, it's well below average. And as long as we have low unemployment and high inflation, the Fed has more kind of room to kind of continue to raise rates to try not to upset the jobs picture. Not necessarily a prediction, but we think it's a reasonable way to think about the cycle of events for how the Federal Reserve, how the economy, and how it interacts with the stock market. Okay, at the very top here, we'll see that the Federal Reserve, this is what they've been doing right now. They've been raising interest rates, right? And the purpose of doing that is to slow the economy, which then is going to also slow down inflation, right? And from a perspective of when we see things start to occur and how lagging indicators take place, we typically see inflation slow down, and then perhaps we see the economy slow, the data come through in terms of GDP, whether or not a recession is going to be officially called or not, right? These are both backward-looking pieces, whether it's the economy slowing down in recession, even the jobs market, this component down here, right? This is kind of the cycle that the economy is going through. What's interesting and what the market, the stock market now, is what they're paying attention to heavily is this piece down here in green, which is the Fed cutting interest rates. Okay, so we're talking about cutting instead of increasing interest rates. So we're shifting gears here. What we see is that eventually the Federal Reserve is going to need to stimulate the economy to spur economic growth. And they're going to do that by cutting interest rates, most likely. This is known as the pivot, right? This is what they're talking about, pivoting from increasing rates to cutting rates. And the reason that's important is that the stock market is behaving or looking ahead to this point in time when the Fed's going to flip to saying we're going to cut rates. It's not going to be this year. We have no indication of that. The Federal Reserve has even said they're going to keep raising rates. But the point or the main takeaway here is that the economy might be hanging out up here in terms, at this kind of 2 o'clock, 3 o'clock range, whereas the stock market's looking ahead down to this closer to 7 o'clock range. So the point that too is we think about how we make investment decisions and how we want to divide up assets and make sure that we participate. Because again, this recovery, we don't know when it's going to occur. We can't tell when the bottom is going to be, but we do know that based on history, the bottoms tend to occur even when the economy is still in a sluggish or really kind of a slower path, or even perhaps in a recessionary period. We looked at midterm elections over time and start to look at and say, when an election occurs, a midterm election, what tends to occur to the stock market after that, okay? And so we start to draw some lines and look at some comparison to say, well, typically what has occurred as the elections have occurred again in November here, typically the stock market tends to rise after a midterm election, okay? And kind of what's even more interesting, if we look at this other section of this graph here, what we're looking at here are the 12-month returns following each midterm election, going back to the 1950s. Okay, and what we see is that in every one of these cases, it's been a positive outcome, right? We've had a positive 12-month period for the stock market after every midterm election, going back to the 1950s. Again, hopium is not an investment strategy, but it's very interesting nonetheless. When we invest and think about planning, we divide up investments into segments or buckets based on both time and different types of asset classes. That's an important part. And what we do is we say in the first segment here, this first 1 to 3 year time period tends to be set aside for income needs in the short term. The other thing I'll conclude on here is when we think about volatility and how volatility occurs in those long-term segments, volatility in the market is clustered together in time, meaning the big ups and the big downs tend to occur in a short time period. And the way it goes, we go back to thinking in terms of time in the market is more important than timing the market. Trying to time in and out is a really challenging task or a challenging objective to do that consistently over time. But what we know is if we have time on our side and we have levers we can pull to reposition things, that in our view is a much more effective way to invest and manage these longer term dollars.